Are you ready to witness the biggest silver price rally in 2023? Get ready because this video will reveal all the secrets and strategies you need to know to prepare yourself for an imminent $90 price rally. If you've been following the market closely like I have, you know that something big is brewing in the world of precious metals. According to renowned technical analyst and trader Francis Hunt, silver is about to experience an unprecedented surge that could see it reach an astonishing $90 per ounce before the end of the year. In this video, we will delve into the factors behind this imminent $90 price rally and discuss how you can position yourself to maximize your profits. So let's jump right in. Francis Hunt is a prominent figure in the trading world where he is referred to as the market sniper. He's the brain behind Market Sniper and the creator of the innovative Hunt volatility funnel and the method that it goes with it. With a remarkable talent for spotting breakout trading chances across diverse assets, Francis has honed his expertise particularly when it comes to precious metals. Francis is a trader above everything else. He's not like most teachers who talk about trading but haven't really done it. He spent 30 years actually trading his own money in a different market and with different things like stocks. He really loves trading and spends a lot of time learning about how markets work. He follows a special way of trading called the Hunt volatility funnel method. This method helps him figure out the best trades that could make the most money next. He believes that the real price of something tells us everything about what's affecting it. To make smart trades, he looks at how prices move over time. In the world of precious metals, historical patterns can provide valuable insights into future price movements. Francis Hunt, the market sniper, draws parallels between past and present in his analysis, making his predictions even more intriguing. During his recent interview, Hunt highlighted the historical breakout of gold above the $1,000 mark as a pivotal moment that bears relevance to our current situation. Hunt emphasizes that history often repeats itself in the world of finance. He points out that the breakout of gold above $1,000 didn't happen overnight. It took a series of 3 major attempts to breach that crucial level. This pattern of persistence finally resulted in a substantial breakout, propelling the price of gold to the precipice of $2,000. Fast forward to today, and Hunt highlights that we're observing a similar pattern with 3 significant attempts to breach the $2,000 level. Zooming in on these attempts, Hunt's analysis provides a keen insight into the complex dynamic of the precious metals market. He suggests that this pattern, characterized by a sequence of attempts and an eventual breakout, might herald a substantial rally in the near future. Hunt confidently predicts that the next major move could potentially drive gold prices even closer to the impressive $3,000 mark. The gold-silver ratio is a fundamental metric that provides insight into the relative value of gold compared to silver. This ratio indicates how many ounces of silver one can acquire with the value of 1 ounce of gold. Unlike other ratios, this one is not fixed and fluctuates based on the current spot prices of gold and silver. The ratio plays a crucial role in analyzing the market sentiment towards these metals and predicting their price trajectories in both the short and long term. Gold and silver, both freely tradable commodities against the US dollar, exhibit fluctuating ratios driven by market dynamics that alter their prices. However, this wasn't always the norm. In the late 19th and early 20th centuries, the US adhered to the gold standard, which fixed gold's value against the US dollar. For instance, in 1944, the US government set gold's value at $35 per ounce, cubing and curbing the flexibility of the gold-silver ratio. The US officially abandoned the gold standard in 1971. Silver greatly influences the ratio due to its dual role in industrial production and speculative trading. Industries like solar cell and electronics manufacturing rely on silver. Its global demand is influenced by economic factors and it's also traded as a speculative asset. Comparing the values of silver and gold, the silver market is smaller, about 1/10 of the size of the gold market, making it more volatile. Its smaller size means less trading volume can sway prices. Historical data suggests that silver is roughly twice as volatile as gold. The S&P 500 index and the gold-silver ratio display an inverse relationship. When the S&P 500 rises, the gold and silver ratio typically falls, and vice versa. Historically, the gold and silver ratio has been influenced by the availability of silver and mining output. Although logic might dictate a ratio lower than 20, it has rarely dipped below 30 in the 21st century. The typical range spans 45 to 85. Some analysts anticipate to return to pre-1900 levels, suggesting heavy investment in silver, but a falling ratio doesn't guarantee rising silver prices. The ratio's historical fluctuations are notable. It represents gold's price divided by silver's price. A lower ratio means more silver is needed to buy an ounce of gold. The ratio hit a low of 32 in April of 2011 during the US stock market's recovery from the 2008 crisis, indicating confidence. In contrast, it soared to a record of 126 in March of 2020 during the COVID-induced market turmoil. One of the gold-silver ratio's most intriguing traits is its historical correlation to significant market movements. Crossing the 80% mark tends to herald a period of silver being undervalued compared to gold. This has historically preceded substantial rallies in the prices of more volatile precious metals. Over the years, whenever this threshold was crossed, silver's price rallied significantly, sometimes by a remarkable 300% to 400%. Now, let's venture into the historical significance of the gold and silver ratio. The magic number here is 80%. When the ratio surges past this mark, it signifies a fascinating turn of events. It signals that silver, in comparison to gold, is significantly undervalued, a trend that often triggers remarkable rallies in the precious metals domain. In recent history, each time the ratio exceeded 80%, silver underwent impressive rallies, clocking in at gains of 30%, 40%, and even a staggering 100%. Now, here comes the exciting part. Hunt's forecast of silver's staggering price surge, a jaw-dropping 700% increase, is on the horizon, potentially pushing silver's value well beyond the 90% per ounce milestone. Hunt's analysis levels on the gold-silver ratio chart. This chart mirrors the proportional dynamics between gold and silver prices, offering critical insights into market trends. Hunt's meticulous analysis maps out a fascinating journey. He anticipates the ratio, currently hovering around 82, to plummet to 65 as gold's march towards $3,000 unfold. An intriguing detail, all this action is poised to commence within a mere 2 weeks. As the ratio spirals downwards, silver's ascent is projected to be proportional. The anticipated outcome, a 65 ratio neckline breach accompanied by a period of churn before diving into the 30s. This cascading effect directly translates into silver's resurgence, inching closer to Hunt's envisioned $90 price milestone. Enjoying this video? Give it a thumbs up and share with your friends and your loved ones. Don't forget to subscribe and hit that notification bell to stay updated with our latest content. Now let's jump right back in. Hunt also delves into the macroeconomic factors that underpin his predictions, shedding light on the broader context. He emphasizes the enrichment of inflation in the economic system, a tool employed by a central bank to manage government expenditures and mitigate the impact of colossal debts. This approach often involves currency devaluation to reduce the purchasing power of fiat currencies, creating a fertile ground for investments in precious metals. Hunt's analysis highlights the interconnectedness of macroeconomic strategies and their impact on individual investments, particularly in assets like gold and silver. In the midst of currency devaluation and macroeconomic maneuvers, Hunt points out the increasing trend of investors turning to precious metals as a hedge against value erosion. As central banks continue to employ strategies that devalue currencies, Hunt predicts that more people will seek refuge in assets that have historically retained value, such as gold and silver. This influx of capital into the precious metals market can further amplify their value, making them attractive options for those looking to protect their wealth from the erosion caused by inflation and currency manipulation. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.